So look, I think that's a great point, and we're actually worried about inflation because there are so many supply side factors here that have created the inflation that we've seen since lockdown, and the oil price is still really a wild card, and what we're seeing now is we can get into a situation where we do end up with softer demand for energy, softer demand for oil, and yet the prices can still keep going higher because of the fact that there's this ability to constrain supply. And again, what you were saying to Karen about Germany, that's really interesting because Germany looks like it's on the precipice of a really significant slowdown combined with a potential inflation spike because of energy prices. If you look at the premiums that are being charged on US oil that's being shipped to Europe right now because of the low inventories in the States, then it suggests that policymakers, aided by OPEC and the other oil suppliers, are doing everything they can to create a potential stagflation, and that's a real worry.
I agree. This is the bit of the interview where we stop talking about all the factors and then we go back to your initial point, which is perception versus reality. Markets were horrible in September if you were long. And I make that point because so many of our viewers play the other side and they've done very well. I appreciate that these were big declines. We're talking 4.7% for the transports, 5.6% for the Russell 2K, 2.7% for the CAC, 3.9% for the DAX. The viewers get my point here. What next, Paul?
That's a really, really great question. And the answer is nobody knows. And so therefore, the right way to play it is probably still, what we've been doing for quite a long time, which is to go with long short managers, because, there's so much dispersion in there that there's great opportunities. And, wherever the value is, seems to be shifting on an almost daily basis. Again, going back to perception, one thing that fascinated us is that if you look at the earnings call data, earnings calls were kind of at levels that they've been in terms of positivity in earnings calls. There were levels that have normally sort of preceded significant corrections. And probably the most interesting thing is if you look at the data for this year, for companies where the CEOs have gone out and talked about AI on the earning calls, well, they're up about 14%. S&P companies, that is, they're about 14%. If you look at ones where the CEOs haven't been talking about AI, well, they're pretty flat year to date. I mean, if MBMG Family Office were a listed company, I mean, luckily it's not. It's a private entity. But if it were a public company, all I'd have to do now is tell you how accretive our AI policy is, and that would go and whack 12% onto the share price. So again, it's this huge gap between perception and reality, and the fact that markets are paying such a premium for CEOs just using the right buzzwords. We've been here before. You and I remember this, Steve. We've been here during the tech wreck. We've been here during the GFC. Whenever we get this kind of premium paid for just, say, CEOs using the right buzzwords, then it's a bad sign.
It's .com.ai all over again, isn't it, in some regards, Paul? I want to ask you about what to do from here because stocks had a wobble over September. Treasuries have sold off. What do you do in terms of positioning into year end?
So I think the opportunity in Treasuries is really clear. Look, they can go lower. I really don't see where Bill Ackman is getting his 5% and above for longer. I don't see where that comes from. I'm not saying we can't make 5%. It would be a slight surprise to us. But ultimately, the longer term direction for long Treasuries to us, it seems like rates will at some point come significantly lower, and therefore this is a really great buying opportunity. It might not be the best one, but it's there may be slightly better to come. But this is a great buying opportunity. With stocks, it's much less clear. So as I say, we're basically sticking to the core position that we've had for a while, which is to use long short managers who basically managed to navigate 2022, managed to navigate this year, managed to navigate September by making money during all those environments, because those guys just need dispersion, and we're seeing so much dispersion between individuals individual stocks between sectors, that for them it's almost shooting fish in a barrel. So that seems like the strategy for now. Yes, it could be early, but we also fancy China domestic focused entities. But in general, we'd really we'd look at any rebound in stocks as an opportunity to sell long portfolios. We've got very, very little long exposure to equities or any kind of risk assets really at the moment.